Welcome to our deep dive on advanced investment strategies. Today, we're tackling one of the most debated questions in finance. When should you go all in and when is it wiser to stay in cash? This decision can make or break your portfolio, especially in volatile markets. We'll explore the logic behind both approaches, examine real-world scenarios, and help you build a framework for making these critical choices. Whether you're a seasoned investor or just starting out, understanding these strategies is essential for maximizing returns and minimizing risk. Let's begin by defining what it means to go all in versus staying in cash. Going all in refers to allocating the majority, if not all, of your available capital into a particular investment or asset class. This approach is often driven by strong conviction, backed by thorough research or market signals. However, it comes with significant risk, as it exposes you to market swings and potential losses. Investors who go all in are betting on a favorable outcome, hoping to maximize their gains. But what factors should you consider before making such a bold move? Let's break down the key elements that drive this decision. On the other hand, staying in cash means keeping your funds liquid and uninvested, waiting for the right opportunity. This strategy is often used during periods of uncertainty or when markets appear overvalued. By holding cash, you preserve capital and maintain flexibility, ready to deploy funds when conditions improve. However, staying in cash also has drawbacks, such as missing out on potential returns and the impact of inflation. Let's look at the circumstances where staying in cash might be the smartest move. The decision to go all in or stay in cash is heavily influenced by market conditions. Bull markets, characterized by rising prices and optimism, may tempt investors to commit fully. Conversely, bear markets or periods of high volatility often encourage caution in cash holdings. Understanding the broader economic environment, including interest rates, inflation, and geopolitical events, is crucial. By analyzing these factors, you can better judge when to take action and when to wait. Let's explore how market signals can guide your strategy. Risk management is at the heart of every investment decision. Going all in amplifies both potential rewards and risks, making it vital to assess your risk tolerance and set clear boundaries. Diversification, stop-loss orders, and regular portfolio reviews are essential tools. Staying in cash can reduce exposure but may also limit growth. Balancing risk and reward is a dynamic process, and your strategy should adapt as market conditions change. Let's discuss practical ways to manage risk while pursuing advanced strategies. Emotions play a significant role in investment decisions. Fear and greed can drive investors to make impulsive moves, such as going all in during a market rally or staying in cash during a downturn. Recognizing these psychological influences is key to maintaining discipline. Advanced investors develop routines and checklists to counteract emotional biases. By sticking to a well-defined strategy, you can avoid costly mistakes and stay focused on your long-term goal. Let's examine how mindset impacts your investment choices. Let's look at some real-world examples to illustrate these strategies. During the 2008 financial crisis, many investors stayed in cash, waiting for stability before re-entering the market. Conversely, in the tech boom of the late 1990s, some went all in, reaping huge rewards but also facing steep losses when the bubble burst. These cases highlight the importance of timing, research, and discipline. By learning from history, you can refine your approach and avoid repeating past mistakes. Make informed decisions. You need a personal framework. Start by defining your investment goals, risk tolerance, and time horizon. Use market analysis, technical indicators, and economic data to guide your actions. Regularly review your strategy and adjust as needed. Whether you choose to go all in or stay in cash, consistency and discipline are vital. Let's outline the steps to create a robust decision-making process for advanced investment strategy. Summary: deciding when to go all in versus staying in cash is a complex, high-stakes choice. It requires a blend of market analysis, risk management, and psychological discipline. By understanding the pros and cons of each approach and building a solid framework, you can navigate volatile markets with confidence. Remember, there's no one-size-fits-all answer. Your strategy should reflect your unique goals and circumstances. Stay informed, stay disciplined, and keep refining your approach for long-term success.